Okay, let's go ahead and run through the solution to example 7.5. This was the second of the three standalone examples of intercompany asset sales, and this is going to be an upstream sale of a depreciable asset at a loss, and the parent is going to use the full equity method to account for their investment. Okay, so as always, Big owns 90% of Little. On January 1st, 2001, Little sells equipment to Big for $30,000. Little had originally purchased the equipment for $100,000 6 years earlier on January 1st, 1995. The equipment was assumed to have a 10-year useful life and zero salvage value, and those assumptions are unchanged. In other words, the asset still has 4 years of life left as of the date of sale. Big and Little both use straight line depreciation, and let's assume that Little reports $100,000 of income each year and pays no dividends. Big uses the full equity method. What we're going to need to do is first provide the equity method entries related to Big's investment in Little for 2001, 2002, 2003, and 2004. Next, we're going to provide elimination entries related to this transaction for those same 4 years. And again, the nice thing about this sort of modular approach is that the S, the A, the I entries, all of those are going to be unchanged. All we're doing is adding a new, in this case, pair of entries to account for this intercompany transaction. And then third, we're going to need to compute the income to the non-controlling shareholders in each of those 4 years. Now, as some background, the first thing we have to do is figure out what would be the gain or loss on sale. Now, the asset originally cost $100,000. It's been depreciated for 6 years at $10,000 per year, so it has a book value of $40,000. It was sold to Big for $30,000, and so Little is reporting a loss on sale of $10,000. Now, that loss is going to be realized over the remaining life of the asset, and it's going to be recognized as an adjustment to depreciation expense. So a $10,000 loss being recognized over 4 years, that'll be $2,500 per year. And again, we're going to do that by adjusting depreciation expense. If this sale had never happened, the true depreciation expense based on the original historical cost and the original useful life was $10,000 per year. Now that Big has bought the asset, they're going to be reporting depreciation expense of $7,500 per year. Again, they paid $30,000 and it has 4 years left to go. And so we're going to kill two birds with one stone here. We're going to go ahead and adjust depreciation expense upwards from the reported $7,500 up to the correct $10,000, and by increasing that expense, that's how we're going to recognize, in a sense, the loss. Now remember, this is an upstream transaction, and we're going to be using the full equity method. Now, it's important to note that this intercompany sale took place on January 1st. That means that not only will we have to correct the asset and accumulated depreciation accounts and eliminate the gain or loss on sale, we're also going to have to correct the depreciation expense for the year. Depreciation expense for 2001 was recorded by Big, who bought the asset on January 1st. And again, they recorded depreciation expense using what we view as an incorrect number. So for our elimination entries, we need to undo the sale. And again, the equipment originally cost $100,000. It's on Big's books at $30,000, so we have to increase equipment by $70,000. Next, we have to reinstate Little's accumulated depreciation. When they sold that asset on January 1st, they would have eliminated their accumulated depreciation account. We need to put that back on the books. And third and finally, we need to eliminate that $10,000 loss on sale. Again, that loss on sale is a debit. It's being reported on Little's income statement, and so we will eliminate it by crediting loss on sale. Now that we've done that, we need to go ahead and adjust this year's depreciation expense. So again, as discussed a few moments ago, we're going to go ahead and basically add $2,500 of additional depreciation expense. This will bring the depreciation expense up to the correct total of $10,000. The income to the non-controlling shareholders, again, the non-controlling shareholders are going to get their share, 10%, of the adjusted/realized earnings. So we start with reported earnings of $100,000, and then we look at those two elimination entries and say, how do those elimination entries affect the income? Well, there was a $10,000 credit to loss on sale. Putting a credit on the income statement raises income. We're eliminating or removing a loss, and so that increases earnings. And then the second elimination entry, we're debiting or increasing depreciation expense, so that reduces income. So the income of the non-controlling shareholders, they're going to get 10% of $107,500, or $10,750. Third and finally, our equity method entries. Again, under the full equity method, the parent records as an adjustment to investment income the removal of unrealized gains and losses and the recognition of realized gains and losses. And you'll note the parallel to the elimination entries. I did the elimination entries first because it's easier to sort of think about it when they're done in this order. That first elimination entry puts a $10,000 credit on the income statement, increasing consolidated income. The parent in their equity method entries is going to record their share, $9,000, 90%, of that increased income as a credit to their investment income. Likewise, in the second elimination entry, we're putting a $2,500 debit on the income statement, and so we're going to record a debit to investment income for 90% of that $2,500, or $2,250. Okay, 2002, the subsequent year. First, for our elimination entries, the first thing we have to do is carry forward the values from the previous year. Looking at those two elimination entries on the left-hand side of the screen, we have a debit to the equipment account for $70,000, and that's all we do to the equipment account, and so that gets carried forward. Next, looking at accumulated depreciation, we credited it for $60,000, and then we had another credit for $2,500 for a total credit of $62,500. What's left, that's $7,500 on the credit side, that's the remaining unrealized loss. And again, now we have to answer two questions. First, was this upstream or downstream? This was an upstream sale, which means that that $7,500 is going to be shared with the non-controlling shareholders. The second question was, does the parent use the full or the partial equity method? Since the parent uses the full equity method, we're going to go ahead and adjust the investment in little account. So once we've carried forward sort of where we left off the previous year, reestablishing these accounts, then we can record another year's worth of adjustment to depreciation expense. The income to the non-controlling interest, again, as before, we're going to give 10% of the adjusted/realized earnings. We start with the reported earnings of $100,000. We look at those two elimination entries and say, how did those affect earnings? The only one of those 6 lines in the elimination entries that involves an income statement account is that $2,500 debit to depreciation expense. So again, we're debiting depreciation expense, increasing expenses, lowering income. So the adjusted/realized earnings will be $100,000 minus that $2,500 adjustment for $9,750 as the non-controlling shareholders' share of their adjusted/realized earnings. Finally, for the equity method entries again, think of the parallel, or look at the parallel between the elimination entries and the equity method entries. In the second elimination entry, we have a $2,500 debit to depreciation expense, and so we're going to record a $2,250 debit to investment income. Same thing for 2003, and again, we have to keep in mind this was an upstream sale, and the parent is using the full equity method. Again, we carry things forward from last year's elimination entries. We've still got that $70,000 debit to equipment account, and again, what we're doing is we're writing up the equipment from the reported $30,000 up to the correct $100,000. We carry forward the accumulated depreciation adjustments. Again, last year we credited accumulated depreciation for $62,500, and then we credited it again for another $2,500. So now we're carrying forward $65,000 of accumulated depreciation. The remaining $5,000 is the yet unrealized loss that we're carrying forward, and we're going to split that between the parent and the non-controlling shareholders. And since the parent is using the full equity method, we adjust the investment account for their share of that. And then we take another adjustment to depreciation expense. The income to the non-controlling shareholders, again, as before, they get 10% of the adjusted/realized earnings. Equity method entries, just like it was back in 2002. In our fourth and final year of this asset's life in this problem, again, the elimination entries, we carry forward the equipment account of $70,000, and now we're carrying forward accumulated depreciation of $67,500. Again, last year in those elimination entries, we credited accumulated depreciation for $65,000, then we credited it for another $2,500. What's left is a $2,500 yet unrealized loss, which we're now going to realize by adjusting depreciation expense upwards. For the last year, our income to the non-controlling shareholders, just as it was last year. And then finally, our equity method entries, just as they were last year. Now, I want you to note the pattern, both of the income deferral and subsequent recognition for both the elimination entries, that is on the consolidated income statement, and on the parent's equity method entries, the parent's individual income. In the elimination entries, the first year we eliminated or deferred a $10,000 loss, and then we sort of gave it back over 4 years at $2,500 per year. In our equity method entries, we followed a parallel sort of pattern, but since this was an upstream transaction, the parent dealt with their 90%. So in the year of sale, they eliminated or deferred a $9,000 loss, and then gave it back at $2,250 per year for the next 4 years.